Hello, everybody. Hope this message of mine finds you safe, good health, and in great spirits. We all are passing through very difficult times. This is an unprecedented situation which you, me, and everybody has never come across and probably will never see in the future. We have seen complete lockdown, complete stopping of all economic activity. The macroeconomic data that will flow in the next 6 months will be bad and ugly. But as soon as we extend the timelines to 12 months, 18 months, 24, 3 years, 5 years, we see a lot of visibility. This crisis, we all have never seen it before, this kind of crisis. This will change behaviors, the way we interact socially, the way we interact in our offices. It will change the consumer behavior, it will change the investing behaviors, but this will be counted as one of the events in the history of the equity markets. There will be delays in payments. There will be a lot of pockets where we will see degrowth in the economy. There will be a lot of defaults. There will be bankruptcies. But the kind of monetary easing and the fiscal stimulus provided by the respective governments will ensure restoration to the normalcy at the earliest. Viruses come and go, this situation will also pass. There are a lot of clinical trials that are happening across the world which are trying to find a permanent cure and a vaccine, and we are confident that in 9 to 12 months, we will see some solution to this. Pre-corona, India was already showing some signs of economic revival. Post-corona, we strongly feel that India will emerge stronger. In terms of the market movement in the last 1.5 months, we have seen complete carnage. We have seen the index hitting downward circuit twice in the month of March. This correction was completely driven by fear, completely driven by irrational selling. Some people call it program selling. I call it irrational selling, where a lot of large caps were down 30 to 40% in single month. This kind of steep fall, especially in the large caps, 35 to 40% decline. This is happened. I would say this has happened in the last 40 years, the first time. A lot of people are trying to compare this to 2008 crisis, but we feel that both the crises are different. In fact, all crises in 1929, 1987, 1992, 2000, 2008, all crises have different characteristics. And if we compare this crisis to 2008, in 2008 we were coming after a 3-year irrational bull run from 2005 to 2008. The markets were leveraged then, but this time both the things were both leverage and stupendous returns were absent from the Indian markets. In terms of the lockdown, I think India has taken a very proactive stance, and that's why India has done much better in terms of number of corona patients as compared to the Western world. We are in phase 3. Phase 3 is the most critical, where there are risks of community spread. So far, I would underline that word, so far, we have done exceedingly well. We already have seen resumption in few economic activities from 20th April onwards. Our sense is opening the economy in phases is the only solution. We do understand that we might see spike in the number of patients going forward, but we have to face it. The closing of economic activity, the closing of factories will actually create a bigger economic problem than corona. So the trade-off of The trade-off in front of the government is, I would say, they will have to go ahead and open the economy in phases. I strongly endorse what the government has been doing. We all, as responsible citizens, have to ensure that if we go out for work, we have to take proper precautions. I keep getting a lot of calls from my friends, from investors. Has the market bottomed out? Is it the best time to buy? If you really ask me, I also do not have the right answer. Stock markets, equity markets are not a game of finding bottom or tops. It's actually identifying the risk reward available and the probability of getting returns, or probability of deriving returns from the market. What we see is that already with the steep fall, there are pockets of value that have emerged. A lot of good quality businesses are available at reasonable valuations. Bottom up valuations, if you do, have become lot attractive. And our experience tells us that such level and market crashes have always yielded better returns in the next 12 to 18 months. Just to give you a data point, 95% of the Nifty stocks are trading below 5-year average multiples. In terms of Capgrow, what we do, I am the CIO and co-founder of Capgrow Capital Advisors. We are very opportunistic in our investing strategy. We try to identify stocks that have strong balance sheets, less of debt, very strong competitive positioning, and try to own stocks for longer term wealth creation for our investors. We run two strategies. One is the growth strategy and the other is a special situation. Growth strategy is basically trying to own, we identify good quality stocks, businesses that have very strong profile, businesses that have very strong characteristics, stronger balance sheets, less debt, sustainable competitive advantage, and generating higher amounts of ROE and return on capital employed. These normally are large caps, and our current portfolio consists of 60 to 65% of stocks in the large cap category, while rest are mid caps. When we say mid caps would be anywhere in the range of upwards of 3,000 crore of market cap. In terms of special situation, this is a niche strategy, and I think this is a strategy which is differentiated from rest of the players. Here we try to take advantage of the corporate actions, the corporate events that have been announced by the companies. The examples are mergers, demergers, buybacks. We also play distressed securities in this. In the past, we have been able to identify stocks at the bottom of the economic cycle, and also situations where the cash on the balance sheet was more than the market cap of the company. This strategy is little volatile because this depends upon the corporate action and is also dependent upon the regulatory approvals. So the risk to this strategy is the timeline of regulatory approvals, which sometimes reduces the returns. This strategy is, as I said, is volatile. And just to give you an example, in the month of February, this strategy was the best performing PMS strategy, and we were covered across the media. And the returns for this strategy were 20% in the month of February 2020. We are very confident that both the strategies align our interest with the investors, and both these strategies will help us identify opportunities in the markets across economic cycles, across sectors. We are very confident that the current market opportunity provides us a lot of opportunities that fit in both the strategies. As I said, this current situation will lead to a lot of bankruptcies, and bankruptcies will lead to a lot of distressed securities, where we would like to identify few securities that can fit in our portfolio. We at Capgrow have a research team of 4 people. We are active managers and we evaluate every investment from a risk reward viewpoint with a long term perspective. We do not speculate. We do not compromise on the quality of the business, on the quality of the management. We may compromise on the returns here and there, but we will never compromise on the quality of the business and the management. Markets have been volatile. We have always assumed that volatility is our best friend, as it gives us an opportunity to own good quality businesses at reasonable valuations. I would like to conclude here and once again reiterate, please be safe, stay inside your homes, take necessary precautions. We will overcome this crisis and we will emerge stronger. We have already seen signs of a tactical shift from China to India, and we are pretty confident that India will emerge stronger post coronavirus. Uh, we at Capgrow are available for any further additional information you may require, for any questions you may have. And once again, stay calm, stay blessed. Thank you.